This is a simple overview of the accounting cycle, starting from transactions, following through to writing a journal to bring the transaction to visibility, to posting that journal to the general ledger, and then summarising the balance of all the general ledger accounts in the trial balance, then going through the close-off process and producing the financial statements and the balance sheet, and finally ending up with a post-closing trial balance. So let's go back to the start, and we'll look at this with a very simple example. The example is you receive $1,000 cash for a sale, and at the moment we'll just use the general journals, though in this unit we have also referred to four special journals: the cash receipts special journal, the cash payments special journal, the sales special journal, and the purchases special journal. So the journal, cash receipt, let's see what happens. We make a sale of $1,000 and we record that cash at bank debit, and we'll see immediately that goes into cash at bank debit in the general ledger. Here we're using T accounts for the general ledger, and then I'll record the revenue item, and so revenue debit cash at bank, credit revenue 1,000, and that will go 1,000 in our revenue. So we can go over to our trial balance and see our trial balance balances of $1,000 each. So our assets are 1,000 and our revenue is 1,000. So when we close off, that revenue will just go straight into owner's equity. So remember that assets equals liabilities plus owner's equity, and revenue and expenses are a subset of owner's equity. That's the first bit of the transaction. The second transaction is expenses $500. So debit expenses, credit cash at bank, and we'll see when we did that debit expenses that we debited the expenses $500, and then we will see when we credited cash at bank, we now come up here and the credit is posted into the ledger. Now our trial balance, assets $500 being the cash at bank, revenue 1,000, and our expenses are 500, still balancing at 1,000. So we get to the end of the period and we can produce our financial statement. So revenue $1,000, expenses 500, net profit is 500. That net profit comes up here to owner's equity. So we've got assets $500 equals owner's equity of $500 with no liabilities. Then we get to the stage of closing off the accounts, and again this would be a general journal. I haven't put in the space for the general journal, but basically what that'll be about to close off the accounts will be our revenue is $1,000 in revenue, so we will debit revenue $1,000 to bring it back to zero. Our expenses are $500, so we will credit expenses. They're currently a debit balance. We will credit expenses 500 to bring that back to zero, and then the difference will go into our owner's equity account. A bit later I will show you these journals in a lot more detail and going through the full cycle of the closing entries.